Hello and welcome. Just going to wait a couple more minutes for people to connect their audio and then we'll make a start. Thank you. Hello and welcome to the Climate Bonds Initiative's 2016 webinar series. Today we'll be exploring the rail component of our low carbon transport criteria with Climate Bonds' Anna Creed, Head of Standards. We are also joined by Carl Peet, Research Director at SLoCaT, the Partnership on Sustainable Low Carbon Transport. First, a couple of housekeeping notes. To keep up to date with our work at Climate Bonds and for announcements of future webinars in this series, you can register for our blog at climatebonds.net. If you have any questions as we go through the presentation, please use the Q&A box in the bottom right-hand corner of your screen. I'll collate them and put them to our presenters at the end. Finally, this webinar will be recorded and sent by email to all those who are registered. Now over to Anna.
Thank you, Johnny, and good afternoon, everybody. Very glad you could join us. I am going to cover this afternoon an introduction to CBI and the green bond market and how it's developing, and within that talk about green bond labelling and the role of standards in that, and then the Climate Bond Standard and Certification Scheme. And then I'm going to move on to talk about the transport criteria and more specifically the rail element of that. And this is part one of two transport webinars. We're going to do a second one later this month to cover the road aspect of our low carbon transport criteria. So this is part one on rail. And then I will hand over to Carl for some expert insights into the transport sector. And then, as Johnny has said, we will then come back and have a roundtable Q&A session. So first up, the Climate Bonds Initiative and what we do. We are London-based. We were created by investors to help increase clarity and improve the structure around climate bonds. We have four main areas of activity. The first is the Climate Bond Standards and Certification Scheme, which provides definitions for investors and guidelines for bond issuers. And those definitions are about green definitions. They're developed through a rigorous multi-stakeholder engagement process, and that was how we developed the transport criteria and all our other sector criteria. And the aim is that this kind of standard, which increases transparency and comparability, will help to develop investor confidence through assurance and certification and help grow the green bond market in those ways. The second area of our work is around, a key part of the market really is robust and extensive data, and so we do a lot of work to provide information flows to rating agencies and index providers, and also we do have a market blog where we monitor and report on climate-aligned bonds and do our annual State of the Market survey, and that's the icon that you can see on this page, so that is available on the website if you want to see the annual snapshot of green bonds and climate change. Our third area of work is around outreach to inform and stimulate the market. So we do work on policy models around green bond market development and green pipeline project development as well, and provide advice to governments on those issues. We are particularly working in and with China, India and Brazil, but of a number of other countries as well, to try and really increase knowledge, understanding and alignment within and across bond markets globally. We also lastly have a partners program, which is essentially a platform for market participants who want to get involved during the formative stages and those who want to get deeper into this space. So please do contact us if you're interested in that partners program. And just recapping what are green bonds, for those new to the field, a bond is essentially just a form of debt. So the bond issuer is the borrower and the investor is the lender. They're usually very, very large debts, so hundreds of millions or billions of dollars or whatever currency they've been issued in. And they're generally, because of their size, used to finance large mature assets, infrastructure projects, really large capital projects. The issuers or the borrowers, really wide-ranging, can be companies, governments, municipalities, banks, commercial banks and development banks. Multilateral banks are often issuing green bonds. An important part of they form an important part of the investment portfolio for investors such as pension funds, insurance companies, and they're really often seen as a defensive investment. So a common saying is that you go to the equity market to make money, but you might go to the bond market to keep money. They generally have lower returns, but they're seen as more secure than equity investments. And a green bond is where the proceeds of the bond or the money that's borrowed is essentially used to finance environmentally friendly assets. And this obviously has an impact on who wants to buy the bond, so which investors are interested in green or climate-friendly investments. And obviously we hope really makes a positive impact in the world. We need sort of $50 to $90 trillion worth of investment to finance low-carbon transition over the next 5 years, and we really see that climate bonds and green bonds have a huge role to play in helping to generate that necessary investment. So while climate bonds have a climate focus and a green focus, which is around mitigation, adaptation and resilience to climate change, in the investment community it's about asset classes. So on this slide we have some of the asset classes that are commonly seen in green bonds, so a number of renewables, so solar, wind, bioenergy, geothermal, hydropower, etc., but also low-carbon buildings, low-carbon transport, obviously, so rail that we're going to talk about today, but also road vehicles, buses, trams, etc., etc. There's an awful lot of money goes into water infrastructure, and sustainable water infrastructure is going to be a key part of a low-carbon future and a climate resilient future, so water assets, very important asset class for green bonds. And also some others here, waste pollution and management, and also agriculture, forestry, other land uses, and then we move out more broadly into things like information communication technology and broadband. They all have a potential role to play in transitioning us to a low carbon, climate resilient economy. And essentially our vision for 2050 is that we are in a world with where we have limited temperature rise to 2 degrees or ideally 1.5 degrees, and we are able to deal with the increases that we cannot avoid. So really the question is, what assets and investments do we need to make now to be able to achieve that? And really that's what green bonds are all about. Green bonds is very much a growth market. This chart is from the latest State of the Market report. And you can see actually the first green bonds were issued in 2007 time from the European Investment Bank and the World Bank. But there has been a big growth since then. 2014 saw a large jump up, so we had a real movement from just more predominantly being development banks before that to seeing corporates really entering the market in 2014 and 2015. And 2016, we are anticipating that there might be a jump up again in terms of green bonds being issued up to a value of $100 billion for this year. And a key part of that estimate is Chinese issuances. So the People's Bank of China has estimated 46 billion worth of green bonds will come out of China this year. And when we look at the range of assets that are included in green bonds to date, the largest portion, the kind of yellow one on the left-hand side, is for clean energy or renewable energy, low-carbon buildings and energy efficiency of buildings, obviously a really important sector as well. Low-carbon transport is this dark blue segment, a very significant role to play. Water, as I mentioned, waste pollution and control. It's probably important to note, though, obviously this is a static snapshot, and we do see all of them growing. So while we see a lot of wind and solar and low-carbon buildings and low-carbon transport at the moment, water is definitely growing, particularly from municipalities and public entities. And even in those smaller segments, so agriculture, forestry, we are seeing small but significant growth trends in those sectors as well. In terms of the attraction of green bonds, the question that we're often asked is, what's the value of a green bond to an investor, especially where it can sometimes cost to deliver a green bond as opposed to a regular vanilla bond? So this slide captures some of those values, both to the borrower or the issuer and to the lender or the investor. From the borrower or the issuer side, it can basically issuing green bonds can build a strong relationship with your investor. It can bring repeat business to you, so investors tend to be sticky. They will hold on to the bonds that they're buying, and they will come back again if you issue further green bonds in the future. Issuing a green bond as opposed to a regular bond, it also can sometimes bring in new investors to you that you haven't been able to reach before, and a lot of people do report that a green bond enables them to reach out to new investors that they haven't actually been able to access before. So that is a positive impact of the green bond entry. And generally we see with green bonds that there is strong oversubscription, so demand is exceeding supply, and this is leading to a tighter yield when it actually comes to market. And on top of that, obviously there is, if you are a green bond issuer, you're strengthening your reputation, you're aligning your core business and your CSR elements within the company and within your operations, which goes down very well publicly and with your business-to-business relationships. Similarly, on the investor or the lending side, I think it's kind of a simple summary of this is what's measured is managed. And one of the key things about green bonds is there is a real emphasis on how the money is going to be used, or what the use of proceeds is going to be. Is it really going to go into green projects and green outcomes? And that level of focus on a particular outcome means that there has to be real transparency on what the money is being spent on, which in itself is a real advantage to investors, that there is greater transparency in the market about how money is being spent and how it's being managed to achieve those outcomes. And again, like with the issuer, they will, investors into green bonds benefit from a strengthened reputation and deeper engagement with the bond issuer and their own company internally on green issues. Okay, in terms of green bond labelling, it's important that if issuers are claiming benefits from green aspects of the bond, they need to protect investors from greenwashing. In the early years, when it was mostly development banks issuing, they have strong expertise, strong internal resources and processes. and so they were often self-reporting their bonds as green and actually had the credibility to do that. As more players enter the market and a diverse set of players enter the market with more corporates entering who are newer to the green bond world, more questions were raised about actually, is this really green? Where's the evidence or the indication of that I can trust that this is actually a green bond delivering green outcomes? And so there's a need for a system of environmental due diligence to review key environmental attributes to really complement existing financial due diligence. Climate change is a really tricky area. There's a lot of uncertainty over climate change risks and opportunities, and it's very difficult for investors who are not scientific experts or climate change experts to really get under the hood of that themselves. So specialist expertise is needed regarding what counts as green, and the more that can be done externally, the cheaper it will be to have that transparency in the market and to enable verification over that one. So three sort of principles here for a good system of environmental due diligence we might point to. One, that it's scientifically robust, that it will actually deliver climate change compatible outcomes. Two, that it's transparent. And three, that it's consistent. It's all very well being robust, but if everybody's doing their own version of robust, it doesn't help investors very much because they still have to interpret different bonds and what different bonds mean by their version of green. So really, it's quite important that there is consistency over these green definitions and green labelling in the market. Three key dimensions to green bond labelling. The first is reach, and this often is influenced quite strongly by whether we're talking about mandatory participation and mandatory rules or voluntary guidelines that participants can choose to adopt or not. The second key dimension is scope, and generally where there is green bond labelling, there's kind of multiple parts to it. One is labelling over use of proceeds and what counts as green, what's identified as a green asset, and in this space you see a lot of talk about green taxonomies or green definitions, green catalogue in the case of China, and eligibility criteria. But the other key aspects of scope are more generic but quite critical around the process for managing the funds and reporting requirements and transparency, just to ensure that there is robust financial processes underlying the operation of the bond. And the third key dimension is the assurance process, which really builds on that last point I made. So if we're going to talk about green bonds and having credibility in the market, it's important that there is independent oversight and review and verification of that. So there's kind of a grading system for this. So a first-party assessment is where the bond issuer does that assessment themselves, they're self-reporting effectively. A second-party assessment is where an independent entity comes in and gives an independent opinion as to whether the green credentials are being met, is being efficiently and effectively managed, etc. And then the third step is third-party verification. Again, that's an independent verifier coming in to make the assessment, but then making the assessment against an independent external standard, not something that the bond issuer themselves has set. That would be the distinction there. In terms of evolution in green bond labelling, I think I mentioned some of this before, but we've seen a variety of approaches to green bond labelling. So when we started with development banks, they were often doing their own self-reporting. They had the credibility to do so. Sometimes there was a second opinion from an independent party. For example, the World Bank's own first green bond had a second opinion from Cicero back in 2007. Really a turning point was in 2014 when those corporates entered the market. They started utilising the new green bond principles and started bringing in the second opinion, so the independent verifier that what they said was green was actually green in accordance with those principles. And then more latterly, we updated the climate bond standard in 2015 so that it not only fully aligns with the green bond principles, but it actually takes it further to define a climate compatible taxonomy of eligible investments and eligibility criteria for a bond to be officially certified. And then more recently, we see countries developing their national green bond regulations. An important example of this is China, who are releasing their own domestic definitions and requirements centered around the green bond catalogue and the taxonomy underneath that. Looking forward, what we're really key is that standards, assurance and certification are things that investors are repeatedly calling for as being key to improving confidence and transparency and ensuring further strong growth in green bonds within the mainstream debt capital markets. And as long as, basically, as long as we can ensure that there's a delivery of credible and quality products into the market, we will see investor demand for green bonds and climate bonds keep growing and keep being satisfied. So this kind of robustness and credibility is a key part to that forward growth. Governments obviously have a key role to play in this, in developing and rolling out mandatory green bond regulations and encouraging market development. And what we really want to see and what's critical to success will be harmonisation of cross-territory standards, whether those are mandatory by governments or voluntary from the financial community, but we really need to see harmonisation of standards and quality assurance processes. In terms of the climate bond standard specifically, it's essentially a robust and effective certification scheme. It provides clear requirements for issuers in two respects. The first thing that it gives clear, objective, sector-specific climate eligibility criteria. So it defines what is green to a sufficient standard that we can be sure that we're on a low-carbon 2-degree trajectory. And it also provides clear mandatory requirements regarding the use of proceeds and tracking and reporting, and that includes an assurance framework with independent verifiers, which must be used to achieve certification. And that certification is awarded by an independent climate bond standard board, which is made up of investors and NGOs with $36 trillion of assets under management. And as I mentioned previously, the green bond principles are fully integrated into the climate bond standard. So if you use the climate bond standard, you can be confident that you are falling in line with the green bond principles and more. It's important to remember, though, that the climate bond standard is an environmental standard and not a financial standard, so investors must always do their own credit and financial analysis. The overall process for certification, it very much aligns with the normal processes and the normal phases of the bond market. So there's two key steps for that. The first is the pre-issuance certification, and during that process, while the issuer is preparing to go into the market and engage with investors, the issuer will hire or recruit an independent verifier from our approved verifiers list, and they will come in and they will do an assessment of the proposed use of proceeds of that bond and write a report on that as to whether that proposal is compliant and whether the financial structures system is compliant with the requirements of the climate bond standard. And that report is submitted to us for adjudication by the Standards Board, who will confirm pre-issuance certification. And at that stage, the issuer can use the certification mark in its marketing documents as it goes out to market. And then post-issuance, after the issuer has closed the book and issued the bond, it allocates the proceeds to its assets and projects. It will basically bring the verifier back in, and they will undertake an assurance review and assurance procedures, and again submit a second report to the Climate Bond Standard Board, verifying that the proceeds have been used in accordance with how they were proposed to be used and that they are still in compliance with the requirements of the Climate Bond Standard. And then the Standards Board will confirm certification. Basically, certification is valid for the term of the bond unless we detect a problem based on the annual reports that are made to us regarding the progress of those bonds and those assessments. And the next slide just details in the visual form the taxonomy and the technical criteria. So I said earlier that the Climate Bond Standard provides a number of criteria so that you can, depending on the nature of the use of proceeds and which sector that's fall into, we basically define what is sufficiently green and on a low carbon climate resilient trajectory for assets in that sector. So we have a whole library of criteria, and they cover all these renewable energy subcategories, low carbon buildings, industry and intensive commercial and manufacturing activities, waste pollution and control, low carbon transport, nature-based assets such as land, water-based infrastructure, etc. On this chart, the blue ticks essentially indicate where we already have criteria through the multi-stakeholder engagement process, and we've released those into the market. Yellow circles are where they are currently under development, and we are looking to release them for public consultation before the end of the year. And the remaining grey ticks, we are looking to start these additional categories later this year or early next year. So it's very much a rolling program to work really hard with our stakeholders to really expand this library of sector-specific criteria. In terms of participants in the certification process, we've got a fantastic range of issuers to date. Some of them relate to the transport world. So we have MTA in New York, the Metropolitan Transport Association, San Francisco Water Power, ABN AMRO, Nordex, etc. So a real range here across banks, financing groups, public entities, development banks, etc. And I mentioned as well that we approved the verifiers for the certification process, and we have an ever-growing number of verifiers who have already been approved, and this is really a growing list. And I think investors appreciate this as a peer group of theirs, and so it helps to, again, build further confidence in the certification system. So moving on then to transport and the transport criteria. Just some very quick background thoughts on the transport sector. Transport is the second largest contributor to global greenhouse gas emissions after electricity generation. So it's a huge sector to tackle if we are talking about this move to low carbon and climate resilient economy. There's a real need for investment to do this in the transport sector. According to the IEA, nearly $16 trillion in additional transport investment will be required before 2050 to achieve this decarbonisation required. And current investment flows are essentially insufficient. There's a real need to scale up and shift investment towards low-carbon transport infrastructure. And leveraging debt capital markets is a really important part of that. Obviously, it represents a huge resource in terms of finance and available investment. So we really need to be able to tap into that if we're going to make this transition for transport infrastructure worldwide. Refinancing existing assets is a key opportunity in the near term, but we're very much also talking about finance for rolling out of new low-carbon transport infrastructure and upgrades to existing infrastructure. So both refinancing and new infrastructure projects are a key part of this picture. Bonds are already used for low-carbon transport. Actually, they've got a really long history of being used to finance low-carbon infrastructure development, and that goes way back for quite a few number of countries. Generally, I mentioned earlier the annual survey that we do, the State of the Market report, where we look at climate-aligned bonds specifically. So this is bonds that are, some of them are labelled as green, but a number are not labelled as green, but they are effectively delivering green outcomes. So we call those bonds climate aligned. And when we look at the bond universe for 2016, we see over 1,500 bonds that we would consider to be climate aligned transport bonds issued by nearly 150 issuers with a value of $500 billion outstanding. So it's a very large slice of the climate-aligned bonds universe. And rail dominates the transport theme. China Railway Corporation is the largest issuer, had a bond out for nearly $200 billion, but UK, France and the US are also major issuers, and we often see government authorities issuing transport and rail bonds against their larger balance sheets. Looking particularly at certified climate bonds, so bonds that have been certified under the climate bond standard, we've already certified a number of rail-related bonds from New York Metropolitan Transport Association, from the Treasury Corporation of Victoria in Australia, and also from Access Bank in India, who were refinancing a pool of transport assets, and that's only in 2016. We quite often see issuers with a whole program of investments, which total many billions of dollars, and they are often kind of stacking or phasing these investments so they can match the natural rollout of the pipeline of investment and infrastructure activities they are undertaking. And this kind of stacking of bond issuances, it can be really, really positive. To be honest, not just in the green bond market, but in all bond markets, can help to build a really strong relationship between the issuer and investors, if investors are likely to be repeat buyers of those future bonds as well. And it can also, if they're issuing green bonds to cover these kind of stacked assets, can really help to raise public awareness that the green infrastructure program is underway and continuing, and quite substantial. So, in terms of which transport assets are considered low carbon, the primary objective of the working group and of all of the Climate Bonds Initiative sector criteria is to ensure that the assets and the investments and projects that are being financed with these certified bonds are really moving us onto this low carbon 2-degree path, or they're helping us to be resilient to climate change that we know is already going to happen and is unavoidable. So for the transport sector, we were really looking to set threshold criteria that would be able to identify investments in the transport space that would really help us to meet the target of limiting global temperature rises to 2 degrees Celsius. The basic approach and the underlying principle that was decided upon by the working group was to set universal thresholds for CO2 direct emissions per passenger transport and per freight transport. And so by universal threshold, this means these kind of values, these emissions target thresholds, apply to all transport modes. And the rationale for doing this was to make it simple to understand, simple to apply for bond issuers, and it's quite important because they go through the process of preparing for market and getting certification very quickly. And especially as this is a new and developing market, green bonds, we really have to make sure that the criteria are easy to use, relatively low transaction costs, but at the same time they're scientifically robust. And by having a universal threshold, like I said, it's simple to understand. It's also technology agnostic, so it ensures an even playing field without having to specify different criteria, different numbers for sectors and subsectors of different types of transport and technologies. The thresholds that were set are shown in this table at the bottom of the page, and they are based on the global stock-wide average of emissions data from the Global Fuel Economy Initiative. And their target, as it was accounted for in the International Energy Agency's 2-degree target scenario. And you can see here that these threshold numbers of grams of CO2 are declining over time, and this is very much to be in accordance with the idea that we really need to ratchet up our performance in terms of energy greenhouse gas mitigation. So there is a built-in requirement to tighten these emission thresholds over time, and that's what this table represents. So this universal threshold is the basic principle. What at Climate Bonds we're trying to do, and with the approach that we take with all of our criteria, is to make it even easier for people to apply these kind of criteria. We use the traffic light system. So we, through the working group, did analysis of which types of transport projects and infrastructure would automatically fall under these thresholds. And we would call those green-lighted assets, and they're automatically eligible. And conversely, which types of assets or projects would never meet these thresholds, and therefore we can quite carefully and clearly say they are never going to be eligible for certification, and they're red-lighted assets and projects. And then in between that, we have amber light, which is where they may or may not fall under this threshold, and further assessment and information is required to determine whether they can be certified or not. So with that in mind, on this slide, I have to use that color coding here. So we have the green, the amber, and the red. So just running through the eligibility criteria for various transport assets. This first category is public passenger transport, and we have in here rail. I've grayed out the stuff that relates to roads, because we'll cover that on the next webinar. But where we're talking about rail, we're talking about urban, interurban, high-speed rail, all different types of rail assets, infrastructure, and projects. And basically, all infrastructure upgrades and rolling stock for electrified public transport automatically qualifies. If it's non-electrified, then you are subject to, and you need to prove that you are going to be below those universal thresholds that were shown on the previous page. Then when we're talking about dedicated freight railway lines, again, infrastructure upgrades and rolling stock for electrified freight rail lines automatically qualifies. Dedicated freight lines for fossil fuel and transport are excluded. And this was an interesting point of discussion in the working group. We do not see fossil fuels as part of the 2-degree future low-carbon climate resilient world, and therefore we do not want to assist in locking in fossil fuel technologies and capabilities in the short term. This is a little bit of a challenge because obviously with rail networks, the infrastructure is often used for mixed use, so the railway lines may be used to part of the time to transport fossil fuel activities and fossil fuels themselves. Part of the time it might be used for a whole variety of other things. So there is a condition in the criteria which is basically a 50% rule. So if your dedicated freight line is used for fossil fuel only a small proportion of the time, you can still get it certified. But freight lines that are dedicated to fossil fuel transport are very certainly excluded. And then lastly, on supporting infrastructure, all supporting infrastructure qualifies as it contributes to achieving the emissions threshold. So really we're talking about railway lines, rolling stock, associated facilities and management, the land that these kind of assets and projects are carried on. All of those are eligible for certification if they are linked to sufficiently low carbon rail activities. And that is the end of the presentation, giving an overview on the criteria. I'm going to hand back to Johnny to hear from our guest speaker. Thank you.
Thank you, Anna. We're now joined by Carl Peet, Research Director of SLoCaT, the Partnership on Sustainable Low Carbon Transport. SLoCaT were members of the technical working group who developed the low carbon transport criteria Anna has just gone through. Carl himself leads research on a range of topics, including financing strategies for sustainable transport, with the goal of supporting the global climate change and sustainable development agendas in both urban and rural areas. Are you there, Carl?
Yes, I'm here. Thank you, Johnny, for that introduction. Everyone can hear me now?
Yeah, loud and clear.
Okay, very good. And thank you to Anna for that detailed introduction to climate bonds in the transport sector in particular. And yes, and I just want to thank, let me see, I'm advancing. I'm looking for the presentation. If you're able to cue that up. But yes, happy to have you.
Carl, if you click on your presentation at the top there.
Okay. Here we are. Okay. Thank you. Okay. So yes, so thank you to CBI for this opportunity for continued collaboration. And yes, I look forward to giving a little bit more of a macro view of the transport sector and how, of course, green bonds will fit into driving the global processes to which sustainable transport will play a very key role. In particular, the Paris Agreement on climate change, the 2030 Agenda on sustainable development, and a number of other global processes that are now emerging and converging. So with this presentation, I'd like to very briefly accomplish 4 things. I'd like to give you an overview of these global processes. I would like to give a sense of how these converging global processes are driving SLoCaT priorities for the coming year, priorities for SLoCaT and our 90+ members. Then I'd like to briefly kind of give a sense of the scale of the issues and to lay out the financial needs required to achieve the objectives of these global processes. And finally, would like to then bring it back to CBI and green bonds, and showing the important role of these bonds in helping to meet the financial needs of, to achieve the objectives of these processes. So as I mentioned, there has been a convergence of activity at the global level. Again, number of processes which really require strong transport systems and very sustainable transport systems to ensure their success. 6 of the processes are noted here. The Global Decade of Action on Road Safety, this actually came into force in 2011, but we're about halfway through that decade. But in just the last 18 months, we've seen the Financing for Development Conference and the Addis Ababa Action Agenda issuing from that last July. In September, we saw the adoption of the 2030 Sustainable Development Agenda, also known as the SDGs, the Sustainable Development Goals. December of last year brought us the Paris Agreement on Climate Change. So that will be a focus of this presentation. And in July, we saw the Nairobi mandate coming out of the 14th UN Conference on Trade and Development, and we are anticipating in October of this year at the Habitat 3 conference a forthcoming new urban agenda to help drive sustainable urban development for the coming decades. So importantly, as noted here, these processes present both opportunities and responsibilities for the transport sector. And in the process, they really will require coordinated follow-up, measurement, and tracking. But even more importantly, they will require very significant financing to ramp up rapidly and at the required global scale. Early last year, the SLoCaT partnership joined forces with Michelin Challenge Bibendum to form the so-called Paris Process on Mobility and Climate, also known as PPMC, which you'll see throughout these slides. And PPMC is an open platform, again, created by SLoCaT and Michelin to mobilize a broader set of stakeholders in supporting effective action on transport and climate change, but going beyond climate change also to drive the sustainable development goals and targets that we've mentioned, as you can see in the processes here, including sustainable urban development and international trade as well. And so I think importantly, Michelin Challenge Bibendum has helped to sort of expand the scope of SLoCaT, bringing in a broader range of stakeholders and really increasing the involvement of the private sector, and down the road, more institutional investments in, again, driving forward sustainable transport on a global scale. So shifting to the second part of the presentation, I'd like to describe sort of how these global processes have helped to drive the forthcoming agenda for SLoCaT and for PPMC for the coming year. This is to be done in 3 primary components, as you see here, which I'll describe in a bit more detail in coming slides. The first of these is a common framework to really bring together the climate change targets and sustainable development goals, as I have mentioned. The second is a global roadmap to help to decarbonize the transport sector in the medium to long term. And the third is a set of Quickwin Actions to help to kickstart this transformational change within the sector so that we can get ourselves on the proper trajectory to meet those longer term goals. And yeah, so as mentioned, this really is to help to develop a broader global narrative on sustainable low carbon transport that can help to set the agenda for decades to come. The first of the 3 components that I have described is the common framework, and you'll see in this clearly draft slide, the goal here is to facilitate sustainable mobility for all in 4 different areas. The first being access, in this case not only access to economic opportunity, but also increasing equity among a range of users and the most vulnerable users of transport systems worldwide. Secondly is to increase the efficiency of transport systems and services, both in operational terms, in economic terms, and really looking for ways to increase outputs for any given inputs. The third of these is focused on safety. As noted here, a large thrust is the SDG target 3.6, which aims to have roadway fatalities and injuries by 2030, but safety goes beyond road safety to personal security, moving freely among public transport systems, and so on. And the fourth area being the climate aspect is to focus not only on climate change mitigation and adaptation, but under a broader umbrella to focus as well on local air quality improvements to make things more sustainable and increase quality of life locally. So once again, this common framework is designed to bridge sustainable development goals and climate change targets to, of course, to improve livelihoods, going beyond greenhouse gas reductions, and really to help define and implement a global tracking framework across the processes previously mentioned. The second of the three components, as I had introduced earlier, is to look at developing a roadmap for decarbonizing the transport sector, and at the same time achieving sustainable development goals in the process. So we've heard, as Anna touched on, the projections from the IEA under the mobility model require that we bring emissions sharply down by the middle of the century and beyond the middle part of the century to look at nearly a zero net emission economy. Not only in the transport sector, but the transport sector, of course, will have to make its contribution. And as expected, we would propose in this roadmap, which is still very much under development, a different set of timelines and trajectories when we're looking at more developed countries, emerging countries, and least developed countries as well. So the green line at the top, or the top line in this slide, represents the required path for the so-called trailblazers, in which we would expect zero net emissions or near decarbonization by about 2060. And the orange line represents the so-called fast followers, most of the rest of the countries in the world beyond the OECD, which would need to essentially achieve full decarbonization by 2080, again, in order to secure the well below 2 degrees Celsius scenario of the Paris Agreements, pushing toward 1.5 degrees. Just a couple more slides on the roadmap, and I'll move through these a little bit quickly, but as you see here, we've identified some key components as we continue to develop this roadmap. Number of topics here, I won't touch on them all, but let me just say broadly, the roadmap, it's essential that the roadmap focus not only on mitigation, but also on climate change adaptation, as suggested in point 7 here in the upper left of this circle. In defining a roadmap, we need to focus, of course, on an urban transformation, as noted under number 1 here, but also on adapting solutions for the rural world, as we will, although the world is rapidly urbanizing, we will continue to have very significant rural populations who will require access to goods and essential services as well. So this will be a key part of the roadmap. And finally, the roadmap must focus on not only on passenger transport, which certainly gets plenty of attention, but also on freight transport, which in fact accounts for about 40% of global transport emissions. So as noted in number 4 in the lower right here, we'll need to shorten supply chains and increase efficiency on the freight side through a number of strategies. Finally, I'd like to touch on just a few approaches that we intend to take in developing this roadmap broadly with our members and our stakeholders. I'm going to take a few of these points, perhaps starting with the 4th point here, which notes avoid, shift, and improve. As many of you are aware, this is a very fundamental framework within sustainable transport, and this suggests that within this decarbonization roadmap, we need not only to improve our current means of transport. It's not all about electric mobility or technological solutions, but we also will need to avoid unnecessary trips, to shorten these trips and to make them, to use them more strategically, and to shift our existing trips to more efficient modes, such as public transport and non-motorized transport. So these will be key steps in achieving a zero-emission economy and a zero-emission transport sector. I'll walk up the points to the third, making innovation take center stage. Of course, we have the need for many emerging solutions, both in the technological sphere, but also in the policy sphere and in operational spheres. And of course, innovation will be increasingly important as we push towards zero emissions. And I'd like to point out once again that financial mechanisms such as green bonds will be really essential to help to create the proper incentives and to drive this innovation so that we're able to meet these very ambitious goals. And let me step up one more to the second point, which reads, key building blocks are already in place. I think in many cases we really do know what we need to do. We know what needs to be done, and what we need to do is mobilize the resources, both human and financial, to achieve these ends. And this is a fitting segue into the third of the three components that I had mentioned, being the Quickwin Actions. And as you would expect, these are actions required in the short term that will help to set a proper trajectory for the transport sector to meet the long-term goals as required by the global roadmap to decarbonize in the second half of the century. And we have identified a set of about 20 Quickwin actions. Obviously, these are to be rapidly implementable. There are a few examples in the lower right of this slide. But other important requirements is that these be, of course, technically feasible, globally scalable. And again, I would point out that climate bonds can go a long way to help scaling up these known solutions more quickly, whether it be through expansion of railways, as we have discussed, through greater penetration of hybrid cars, hybrid electric cars moving into electric mobility. And of course, with these Quickwin actions, we can start to drive those innovations that will be necessary for the medium to long term as well. So moving now into the third area of this presentation, and I will continue to keep it moving so we have time for hopefully a few questions at the end. But I just want to give sort of again, the scope of the issues involved, what's really needed to meet these climate change targets and to reach the Sustainable Development Goals. The figure you see here shows the fairly daunting task we have before us. The red line, of course, represents transport sector emissions under a business as usual scenario. These are projected to roughly from 1990 levels to roughly triple by 2050 in the absence of any action. Certainly, we are trying to start to turn the ship, but we see that the goals required by the Paris Agreement are quite ambitious, with the blue line representing a 2-degree scenario. We would need to roughly hold emission levels roughly level from 1990 out into 2050, and under a 1.5-degree scenario, we would need to roughly have these levels. So all things are possible, but of course there's a price tag involved as well. As noted at the bottom of this slide, projected roughly $13.5 trillion in investments are needed over 15 years to implement the NDCs, the nationally determined contributions defined by member states under the Paris Agreement. Of course, transport is only a subset of this total, but I think it's really important to note that the NDCs currently don't have a sufficient level of ambition to meet the goals and to meet these 2-degree scenarios or the more ambitious 1.5-degree scenario. So this price tag could rise even further. The table in this slide noted that there's a lot of data here, but if we can turn our attention to the second column from the right, this gives some projections of various studies of annual transport infrastructure needs at global scales, at a local scale, in this case focusing on on Asia in particular, and some sub-regional and national scales as well. The punchline here, again, is there's a need somewhere between $500 billion and $1.5 trillion, some estimates going up to about $2 trillion per year globally being currently allocated to transport. But if we are to make these systems more sustainable, if we're to avoid the lock-in of the high carbon transport systems, there's in the short run an upcharge to that as well, with estimates between about $250 billion and about $500 billion per year that are needed to make these more efficient. And I think most importantly, the non-OECD countries, which are, generally speaking, growing more rapidly, motorizing more rapidly, would need about an estimated 50% increase in current investment levels in order to make this transport systems more sustainable and to set the proper trajectories in the long term. And the public sector may not be in a position to make these investments alone. So once again, we see a very clear need and perhaps very high potential demand for green bonds in the future in many parts of the world and in hopefully a broader set of countries as we move forward. So the final slide of this piece is to touch upon the investment needs to achieve the Sustainable Development Goals. I'll talk through this figure very, very briefly. This really suggests that although transport does not have a standalone SDG under the 2030 Development Agenda, it plays a very key cross-cutting role in supporting the attainment of a number of SDGs across a number of targets and areas and sectors. So the inner ring here represents 8 different SDGs, which really rely on sustainable transport for their success. The inner ring represents a number of direct targets, such as targets on road safety, energy efficiency, sustainable infrastructure, that transport supports in a very direct way. And the outer ring shows 6 different targets, which are more indirectly supported by transport, access to safe drinking water and increasing agricultural productivity. And so, again, very essential that these investments continue in order to achieve a broad range of Sustainable Development Goals. Once again, we see the price tag at the bottom, estimated $1.5 to $3 trillion per year to meet all the SDG targets. Actually, the lower of these is about 10 to 15 times available official direct assistance, and therefore, again, we need to look beyond the public sector and beyond governments in order to make these ends meet. Again, transport is a subset of this, but it plays an important level, it plays an important role and is an important lever in, as I said, achieving a broad range of other SDGs. So really wrapping up here, just want to point out, bringing it back to the CBI Low Carbon Transport Standard and making the link between these global processes and the more specific information that Anna has delivered earlier in this webinar. I just want to touch on 3 points that were sort of guiding principles for establishing the low carbon standard from the Transport Working Group, or the Technical Working Group. So first, only ambitious mitigation can decouple transport emissions from economic growth. We've touched on this a bit. We need to go beyond just improve, also looking at avoid and shift type strategies in order to make sure that we can continue to grow economies while making transport emissions head downward instead of steadily upward. Second point, decarbonization of the sector will require more than incremental change. We've talked about the more disruptive change needed by this global roadmap, the quick wins to spur this change in the short term, and again, the performance standards required by CBI and the downward path really demonstrate and will force the need, or I should say, will drive the need for more transformational solutions. Finally, the radical decarbonization is dependent on broader policies, so we can put our eggs into the electric and hydrogen power transport baskets. These are very important directions to pursue, but we need to also keep in mind that more systemic changes will be required for broader adoption. of these strategies. And therefore, I just want to emphasize once again, the transport bond criteria are very rigorous, but also very flexible so that we can continue to meet the needs of an evolving transport sector and to, again, help to drive those innovations that will help us put us on the trajectory to clear the very high bar set by the Paris Agreement and the SDGs. So with that, I would like to thank you again for this opportunity to present. Thank you for your attention. And I look forward to, hope to see some of you at forthcoming transport days at the Habitat 3 conference in Quito and at COP22 in Marrakesh. And once again, thank you to CBI for this opportunity and look forward to continued collaboration in the future.
Thanks so much, Carl. Great to get some context on the wider landscape in which our criteria sits. We're almost out of time. Just time for one question. How was the decision made to have one threshold for our criteria as opposed to national, regional levels? I'll hand it to Anna to start us on this one.
Thank you. Yeah, it's a really interesting question, and it's always something that comes up with all of our sector criteria about how we balance national and regional priorities and policy initiatives with kind of absolute targets that we're looking to set. And basically, we've gone with a universal threshold just due to the variability that you can see in some of the national and regional targets. And what the group wanted to do was to set a really common, ambitious threshold that can be applied globally, regardless of where the bond issuance is coming from and where the infrastructure project is happening. So essentially, the universal threshold can then be used to qualify or certify all projects that we judge to be an important part of the sustainable transport mix for a low carbon economy, and really putting us on that 2-degree pathway. And some of them, some regional, national policies might require something higher, but some might be lower. So to avoid that variability, we've just gone for a universal threshold that puts us on the right trajectory if you're on that below that threshold.
Carl, is there anything you wanted to say on that?
Unmuting now. No, I think again, I just wanted to get back to the flexibility and the rigor piece. I think having a very, I think to avoid picking winners and saying that, we need to go in this direction or that direction with regard to a particular technology, a particular mode, we want to really keep this market mechanism as fluid as possible and allow for those innovations to emerge, and also for the known solutions to really advance as needed. So no, I think the universal threshold really allows that to happen, and again keeps the really essential rigor, and as I said, keeps setting that bar as high as we need in order to meet the really real science-based targets of the Paris Agreement.
Thanks, Carl. That's all we've got time for today. A big thank you to our guest speaker, Carl Pete from SLoCaT, and to Anna for her presentation. Just a reminder that this session was recorded. I'll send links for this to all those who have registered. I'll also include links to sign up for the second part of this webinar. This will focus on the road-based components of our criteria and will be in early October. To keep up to date with all things climate bonds, including future webinars on our market analysis, you can sign up to our blog on our website, climatebonds.net. Thanks for tuning in today, and have a good day.